I'm good. Well,
I'm just gonna hit record. What's going on? Good, long time no see. Trying to think. We did this. I don't know how long it's been. I forgot to look before we started.
that's a good question. I believe it was last year. So maybe things were a tiny bit rosier in the market, if that sounds right.
Yeah, I feel like it was. I feel like we were almost in like a hot spot, actually, if I can remember correctly.
Yeah,
Not the same situation today.
yeah. I think of the famous Shane White portfolio. I think technically I was bullish on Hormel and Spam is where I was back then.
I remember that.
Um,
And
so
Snapchat did really well. I remember that from the last
and then
time.
Snapchat fell off a cliff pretty fast.
Yeah, that's right. Yeah, to be honest, Scott. So I was really excited to get you back on. I've been thinking just with how much craziness has been going on, it would be fun to talk to you. You're like one of the people in my portfolio of people that I trust to get a good, strong opinion about what's going on in the market. And with everything going on in my life, I feel like probably, I don't know, honestly, the last 6 months or so, I've spent less time than I normally do, just keeping an eye on things. And when I do, I just see red. So I'm like, oh God. And I just go back to what I'm doing because I honestly, I'm just like kind of like keeping my head down and thinking like this will pass. But then when I take a step back even further, man, it's been, I don't know about a lot of people, but my portfolio is just in tailspin mode. So figured I'd have you back on and see what you think is going on and just get a good rundown of the market for everyone listening.
Yeah, well, again, thanks for having me back. It's always really great to see you. I know, again, Scott Bennett with Invest with Rules. And really, I think no better time, even still now, to follow rules when it comes to investing. As we now, as you've seen over the last, call it year, just how incredibly volatile and just incredibly volatile stocks, ETFs, really everything can be. Even as simple as people think bonds is safety is not so safe. So I always take a step back and just I look at things through a very data lens, and I follow two really simple rules, which we'll cover today. But again, rule number one is buy what billion-dollar fund managers are buying in uptrends, and uptrends is so important because there aren't that many. And then sell what billion-dollar fund managers are selling in downtrends, and that applies to both stocks and ETFs. And there's so many downtrends, and there's so many people out there who either A, don't have strong selling rules. I know I've listened to your podcast and you're kind of a habitual buyer, never seller.
And I will
And
say I've held on to that through this. I just keep buying stuff. So I don't know.
well, I think the danger,
Not that I am, you were definitely the one I should be listening to more and more, but I have kept true to that this time. Because if you remember last time when
yeah.
the whole thing happened with COVID, I sold a ton of my stocks and I kicked myself for it. So I said, this time I'm just going to hold on. I don't have to have it right now. So I'm just going to hold on and see what happens.
Well, I think the biggest challenge to that thesis. So obviously, if you're ever going to get out, you need a process to get in. Nothing's ever going to be good when you're based on your gut. But compounding is magical when the market's great, but compounding is ruthlessly bad when the market's horrific. And
Okay.
I mean, if you drop 10, it takes 11 to get back to even, no big deal. If you drop 30, you need 43 to get back to even. That happened pretty quick in 2020. But if you do drop like the crypto holdings of like 70, it takes 233% to get back to even. And that
Yeesh.
takes years. And that takes time off of the compounding clock, where in a commission-free world, this is my opinion, but in a commission-free world where it costs nothing to buy and sell anymore, just to take I think binary decisions like an all in or all out are so difficult. But even if you scale a little bit out or in, that even action should help your psyche a lot.
Okay.
I know,
Yeah.
granted, there's taxes in a non-retirement account, but I just I can't. I truly believe in just having some sort of a defensive process to an investing strategy.
No, that makes a ton of sense. So, one of the things when you were talking about just the background of your rules, and one of the reasons I love what you do is because there is an analytical approach to this, and I think a lot of people just use the gut method. To your point, so I'd be really curious to know, even in the last 6 months, have there are some of these billion-dollar fund managers that you follow with your rules, are they making money in this environment? And I'm assuming there must be some shorting going on and some other things. Like, That's where my head goes right away when it's a bear market. Like that's how you make money. But I'm one of those people too, and that might be a whole different bowl of noodles to get into is shorting. But I don't know. It's something I've never really delved into too deep. I've just always felt like it was more of a risk and a gamble than anything else. But just curious, just from a high level, what you're
Yeah,
seeing.
so I follow a large array of these billion-dollar fund managers. So they can come in the flavor of like pensions, hedge funds, mutual funds, ETFs, private banks. Anything that's over $100 million needs to report. But I have other processes that get me a lot of data a lot quicker. That's very ethical. So the answer to your question is most of them are down less than the market.
Okay.
But still, it's not. I mean, don't get me wrong. We live in a psychological society where even losing feels terrible. So even if you lose less, you're never really thrilled with that.
Right. Yeah, sure.
But the two parts to my process that I truly believe in, number one is what these billion-dollar fund managers are doing, and they've made a lot of money. They were late, but they made a lot of money in energy. They were high. They have a lot of some of the long only they can't short. They hide is what they're doing. So, but there's really nowhere to hide this year. So even utilities and energy have been under pressure too, which has been the hiding place.
Okay. Yeah.
So the first part of my process is all about just what are these billion-dollar fund managers doing, but I'm always like, what could go wrong? And I think the two things can always go wrong are billion-dollar fund managers although they are wildly bright people, men and women with huge research staffs, huge sums of money behind them, they can get it wrong. And you don't want to be always just simply buying because funds are buying. Let's say hypothetically they regretted their purchase, so you're definitely going to regret your purchase.
Right.
And then secondarily, markets can pull back and they can crash. So the second part of my research is again no opinion, it's just data. I call it a trend roadmap, and it just over different time periods tells me, are we in uptrends, neutral trends, or downtrends? And that overrides, because it's a level of risk management, because I'm not immediate. I'm 30 days behind on most of my data. So
Right.
that tells me that things were looking pretty sour to start this year. And it's been a pretty kind of a defensive, primarily defensive year. There's not that much that looks that appealing in today's world.
Got it. Yeah. No, that's crazy. Right. I feel like it's been like a slow decline of just like bad news almost. And I like I said at the beginning, I think I've paid less attention to the news this year than ever since I started watching the news. And I don't know if that's just because I'm busier or because I've lost faith in a lot of it. But the financial markets are the one thing I always at least keep an eye on to some degree every day. And yeah, it just seems like it's just bad news after bad news after bad news. So given what this year has looked like so far for you, and I know you had some slides prepared. I don't know if you want to go into just like, I don't know, your thoughts right now on the current market. And I'd love to just get your overall opinion on where things are and where you in your rules are kind of putting, I guess, your best foot forward right now.
Yeah, so I break out a lot of my research for members based upon their free time, because time is the biggest challenge when it comes to investing. And a lot of the time, I think it's hard to stick with the process. So I have strategies simply for those who have very little time to those who really want to pick individual stocks. But I would just say that we are very much in an unprecedented time where a year ago we were there's stimulus, and we were kind of at the back half of the hardest part of COVID-19. And it's really hard to do year over year comparables when last year's numbers were just outstanding, and you can't keep up with that type of growth. It's just, as much as capitalism is always focused on increasing your profits, increasing your earnings, it's really hard to compete when the data is unfortunately deteriorating from last year. So you look at this time where anyone who's now in the home buying process is really struggling, where the demand for homes are dropping, interest rates are rising, inflation is lingeringly high. In any ordinary circumstance, if inflation wasn't this high, the Federal Reserve would be loosening monetary policy. They'd be lowering interest rates. They would not be quantitatively tightening and kind of decreasing their bond buying program and what's on their balance sheet. So because we're in this kind of just deterioration of data plus a really tight Fed, anything that's like even like a semblance of a bounce has been just sold into. So it's been this really incredibly hard market. So there's so much negative data. So that's probably why you stopped looking at the news so much. It's just
Sure.
it's draining. Is this the reality of it? So what I simply am doing, this trend roadmap just simply tells me, okay, well, it's time to play defense in US stocks. It's time to play defense in some international equity investments, Bitcoin. So almost every asset class, a large majority of them are in what I would deem as a short term. So over the last few days and weeks, and the longer term, which is, I call it maybe more weeks and months, they're in a downtrend, both sides. So because of that, this is defensive mode.
Yeah.
For me. I'll stop there, but that's kind of what I see. And the other thing that's interesting is commodities, which have been boiling red hot. So predominantly energy prices. Those pulled back last week. They're kind of bouncing around today. The softs, so like the food and the precious metals, they started pulling back too. So it's like, wow, what a challenging time where cash has been kind of friendly.
Yeah.
And it's a lot more fun. I mean, I think the US dollar's up 8% this year, while the S&P 500 is down 20 and the NASDAQ's down 30. So it's like, whoa, what a challenging environment to invest long term.
Sure. Yeah. And for people listening too, the one thing you just hit on, I think is really interesting that I think a lot of people maybe don't know a lot about. What could you kind of go into the Fed side? So I think understanding a little bit more around the Fed's ability to change the interest rates and then what that means for home buyers, for example. Like a lot of people listen to this are, I think, in that age group of maybe buying their first home. So when they increased the interest rates recently in the last couple of weeks, what does that mean, just in simplest terms, for people who are in the home buying stage, for example?
Well, very simply, they're affecting the rate in which banks borrow for themselves. So when it comes to what the Fed's doing, is they're in essence making the borrowing ability of our society either easier or harder. And the bond market are very, very smart people who front run lots of different things. I remember when I worked at Fidelity for 16 years, I used to go to these meetings where you'd hear from stock fund managers, you'd hear from bond fund managers, you'd hear from money market managers. And these are wildly intelligent people. And the bond market's 3 times the size of the stock market.
The bond market is? I didn't know that.
Enormous. It's a treasury market. It's why we're the world's currency. It's because you can flood. There's so much money going in and out of treasuries.
Didn't know that.
So, yeah, it's enormous. So because of that liquidity, because of what's going on, you have these bond funds and you have bond fund managers. They know that the Fed is raising rates. So very simply, what they're doing is they are also kind of moving around their portfolios to adjust for that as well, to not get hit so hard. So it's a really interesting time where you've just seen mortgages go from over the past year-ish, and so maybe from 3 to the high 5%.
Yeah.
Not including points and fees and everything else included. So if you're a new home buyer, your payment just doubled, which is kind of stifling for trying to get into your first house.
Well, and on top of that, so that's the key I wanted you to explain. So your price just doubled already on top of a housing market that's so inflated, right? Like it's crazy. I'm sure you can see this in most big cities, but here in Chicago, I mean, even our house, we bought this house, it's a ranch in 2018. It's gone up 25-30% in value in 4 years. It makes buying, I mean, anyone buying a home, but especially someone like trying to buy their first home, it's almost made some of these areas and some of these cities like impossible to live in or at least own a home in right now.
Yeah, and rents are going up too. So and then also if you were to decide to sell your home, then you got to kind of go on the other side. What are you going to buy next? So, sure. And now you have to kind of reposition your potential mortgage, and now that's going to be a steeper payment for you. So it tightens it tightens like everyone's pockets, and it decreases the amount that you're going to be able to spend every single month, if you're living on a tighter budget. So it it affects everyone, from just the everyday worker to the ultra high net worth investor. So it really tightens the system, and what it's simply doing, it's slowing down demand. And when you slow down demand, you're not going to shop as much. We are a very large consumer-based economy. And I don't want to sound so pessimistic, but that's just what the data says. So,
Yeah.
so you could, I mean, that's why the market's off 20%, so far year to date. And it was down again last November too, is kind of the peak area. So could it get worse? It's possible. I follow kind of technicals and price on that trend roadmap, which helped
Right.
me to determine where we're going. Because as much as I think you figured it out, it changes so quickly.
And from your perspective, being into the weeds of the data, what's your crystal ball view right now? Like, I know it's probably something you don't want to necessarily pick a number, but do you think this is going to continue for a while, or do you see is the light at the end of the tunnel to some degree? What do you think?
I am more cautious. The honest answer is, so like when would the Fed ever turn course is the question. And at
Okay.
the moment, you need to at least see inflationary data, whether it's the producer price index, those who make the products, or the consumer price index is what we're all buying. You need to see those numbers go down. And the very first thing you need to start to see is the price at the pump go down. So,
Sure.
and that had, I mean, it's maybe slightly went down last week, but barely. So until you start to see that type of activity happen, you're not going to see the Fed being helpful. And this is potentially going to get worse. So what would make me change course, obviously, is if we see price movement improve. But this is a bearish environment for bonds. It's a bearish environment for stocks. There are some kind of like shining like areas of the market that once a market has fallen this far, so like some tech stocks are down 50 to 70%, like there is some intrinsic value out there, but there's still a lot of headwinds.
Mm-hmm. No, that makes a ton of sense. So it's interesting if the fuel prices are an early indication of potentially this turning around. And this isn't a political question, just more curious. How much of that do you think is a direct indication of what's going on over in Europe versus other indications here? Like, if that war continues, for example, is that still going to be a key driver, you think, to the oil price inflation that we're seeing today? Or are there other things that we can do as our own country to, remedy that and get the prices down? That's, I guess, where my head goes, is that the direct correlation? And does A need to happen before B happens, or is there other options?
It's a really dynamic question.
Sure.
But I would say that there's a chance that things get worse in the winter. So if there is a majority of Europe that is somewhat dependent upon Russian energy and energy prices, that's going to be really hard. I mean, I always think about with my family, it's almost like whatever that energy bill comes in every single month at, I'm not going to question it. I need to heat my house in the winter for my family to keep
Right.
my young son and my wife warm. And so the question is at some point you just kind of have to deal with it. So in theory, can prices get a lot worse in higher peak times overseas? I would assume it probably could. In the United States, 2 years ago, we were talking about no more fracking, no more drilling, no more production. And we have a lot of we're primarily self-sufficient. But that's going to drive, it's a global economy. We're going to drive prices up everywhere.
Sure.
And I think that's an area of that. I mean, I watched billion-dollar fund managers a little late to the game. Back a year ago, the S&P 500, 3% of the S&P 500 was energy. And I watched billion-dollar fund managers gobble up shares of energy companies. So very simply, that was on my reports every single month that I share with members. I purchased a energy ETF, just for those who don't have the time or want to deal with extreme volatility of lots of tickers. It's up around 100% from a year ago. So I don't, as much as it's like there's so much negativity in this world that could affect the energy prices, there are ways to offset the price at the pump. And one of those is to participate in what's in uptrends. And that is a very clear uptrend last year. And when there is extreme volatility and extreme risk, they're going to pull the prices down a little bit. And that's so far what we've seen.
Got it. That's wild. The next thing that comes to my mind on the flip side, so I was hitting on, maybe younger consumers who are thinking about making a major purchase, like their first home. I know my parents are probably going to listen to this episode, and they're on the other end of the spectrum where they both just retired like a month ago. So they're on the other end where I think, obviously they're like, well, what should we, and they have a financial guy, and I'm sure they're having tons of conversations. But for folks at the other end of the spectrum, or maybe you were looking forward to retirement, or you just got into retirement, do you have any suggestions on that end of the spectrum of where to maybe move some funds, or just in general where your head goes as someone who's deep into this?
Yeah, it's well, first, congratulations. That's a big feat for your folks. That's awesome.
Shout out mom and dad.
Yeah, absolutely. That's a hard achievement. That's phenomenal.
100%.
When I was a practicing certified financial planner, I'll kind of give you it sounds good. Historically, it makes sense, but that doesn't mean things can't get really harmful. Because I sat across the table from retired families in 2008, and it was really hard. And
Sure.
I was relying on my previous company, and what most of the investment portfolios look like are some version of a pie chart of a percentage in stock, a percentage in bonds, and a percentage in cash. And if we start with the stocks, we now know that they're down about 20%. Bonds are down about, not long-term bonds are down about 20%, but shorter-term bonds are kind of more kind of single-digit negative. And cash still pays nothing. It's kind of like when you're at the gas pump and they lower the prices really slow. The investment companies raise the interest rate on money markets really slow. So you're getting this interesting time period where you're in this portfolio of, let's call it like 60% stock, 40% bonds, or 50% stock, 50% bonds, and you're down like 10 to 12%. And it doesn't feel that rotten yet. But I remember in September of 2008 when the next leg went down. So you get these little bear market rallies and the next leg goes down. And the question is what's going to hold up your portfolio? And I don't want to, again, I feel like this, like, oh my gosh, like we're in downtrends. And when we're in downtrends, it's almost unemotional. I'm just really defensive.
Yeah.
And that's exactly where we are when we're having this conversation.
Right.
So I truly believe that as an optimist, just holistically, that we'll get through this. Most likely the Fed will probably reverse course at some point, maybe next year-ish, which will then kind of send everything kind of right back up when they change course. So that's possible. Again, it's a prognostication at best.
100%.
So when someone's retired, I do think that having some barrier of dealing with several years of kind of average to poor markets is really, really important. I know cash is just like, oh gosh, it pays nothing, but it sure does a lot better than being down 20. So having that cushion is really, really important. And I also think that having some version of inflation protected income streams are also important. I know Social Security goes up a teeny tiny bit, but hypothetically, if Social Security goes up by 3 to 4%, and inflation's at 8%, that's not great. But if your payment's just straight flat, that's absolutely lousy. So that's kind of where the financial planning world would be. Areas of the market that I think are intriguing today, which I could always change course. The question is what economies have gone down like we just went down in 2020 that are recovering? And are there any countries or economies that are actually not tightening and they're stimulating? And the first one that comes to mind, I know everyone's always a little bit cautious when they hear this, but it's China. And those prices have fallen because of just simply lack of demand, COVID, regulation problems. They're down huge, but the data is improving. So you're looking at a situation where they're coming out of COVID, similar to how we came out of COVID in 2020 in that April, May timeframe. They're right there. So,
interesting.
And they're loosening monetary policy. So, and I think the world's catching on to that trade right now, as it's now looks like it's bottomed and coming up. So that's a really interesting area of the market that I've encouraged members to really do some homework. I've shared a couple individual stocks. I've shared the baskets or ETFs, but it's hard to find uptrends besides shorting the stock market.
Yeah.
There aren't many.
Are you a big shorter? Like, do you do some shorting yourself?
I do in incremental times. So
Okay.
in level one, I do believe that if you are going to hold just a very simply stock indexes like the S&P 500, the NASDAQ, small caps or international baskets, if you're going to hold these things, I do encourage, because we live in these really challenging times and they can last longer than we think, to have a process. Not like I'm negatively so biased that I think the world's going to come to a collapse, but over a couple of days or weeks or months, could you apply a hedge so that your basket of stocks, they don't fall as far? That's what I have recommended. And simply you would be flat for the year given that strategy versus being down negative 20%. And that take your net worth minus 20%, that would be horrific. So that is something that I do share signals. Some members take me up on it and they're happy, and some members probably wish they did that a while ago.
Sure. No, I bet. Interesting. So I know we have, roughly 12 minutes or 10 minutes left. One of the things I definitely wanted to hit on is everyone listening, if this is your first time listening to Scott on the podcast, I think this is your third podcast with me.
It has been a pleasure.
Yeah. I was gonna say, I think we've done 3, which is awesome. You're in a very small club of people who've been here 3 times. So thanks for taking so much time.
Yeah, that's like a 5-timers club. I love it.
But so I wanted to make sure we spent some time. You're hitting on it a little bit, but would you mind giving everyone a rundown of the group you're talking about, the club that you have, and really, like, this is what you do. So would love for everyone who's listening. Obviously you have a wealth of knowledge and you're giving everyone some tastes of it today and your opinions, but would love to spend some time going into what you do and maybe sharing how people can get involved and learn more and get on the train, just like I need to do.
Well, I do. So Scott Bennett, investwithrules.com.
And I'll add all those links to the show notes.
You're the best. I do share what I'll call a web class or a training. And very simply, what it does is it goes over the rules that I follow. And again, I want to be on the right side of big money. So what are they buying? What are they selling? And then also I want to be on the right side of the trend. So that is a process that I absolutely believe in. I always think when I sat back in 2008 working for a $1 trillion company, I always just thought, like, instead of delivering, like, we're in this later mid-cycle economic phase, just to be really blunt and say, you know what, based upon where we are right now, this is a sell. And you would get that way ahead of when the news and way ahead of all the pain. So I came up with these 2 pieces of research. One is what these billion-dollar fund managers are buying and selling. And 2 is this trend roadmap. And when you put those together, it gives you an awful lot of clarity to say, okay, well, should I be kind of stepping on the gas pedal with my portfolio? Should I maybe take my foot off the pedal at the moment and kind of coast just to see where things are, maybe uncertain, or really, should I hit the brakes? And the reality is starting in around November of last year, we were hitting the brakes. And then we hit the brakes really hard in January of 2022. There was this kind of shimmer of hope where the market bounced. Bear market bounces happen. They're usually around 7 to 10%. They last for around 15 days. We'll identify them if someone wants to take advantage of them, but we're never totally going to know the low until the low is really in. That's the hardest part in the world, is picking the tops and the bottoms, but we'll be on the right side of the trend the whole time. So that's what I do. I always have the joy of access to the Shane White portfolio. And what's really interesting is you have great companies and they are good businesses, good business operators, but we live in an environment where there's just tons of headwind. And out of all of the stocks in the Shane White portfolio, there is one that is technically in an uptrend. All of the rest of them are in neutral or downtrends.
And
And
I need to update that. I have not that I have added anything to it. I just have not been. I've like kind of what you said. I've kind of been just like hands off the wheel and just kind of like holding on. And I'll maybe throw a little bit more into the stuff I already own. But that's not good to hear. That's not good. The last time we talked, it was a totally different story. So this is a bummer.
I know, I'm sorry to hear that.
But hey, the truth hurts.
But do you have a feeling which one is the sole uptrend?
If I had to guess, no. I honestly, everything I'm running through my head is just like down, 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 double down.
Um, we're on it right now. It is ZM Zoom.
Okay. Because
So
that had a little bit of a dip, I think, last time we talked. I feel like everyone thought we were maybe going back to the office again and all that fun stuff, and now we're not. So
their amazing numbers were at the beginning of 2020. And they have done just horrible all of 2021 because it went, I think, to a stock price of like 580 something. And then it went all the way down to 100. And part of it is the fact is, how do you keep up with this massively large exponential growth of COVID? And the answer is you can't. You lost an enormous amount of value in that stock, not you personally, but just anyone who bought near the top. And now the question is okay, well, if you're a fundamental investor, can they monetize like the phone? Because they have a better mousetrap than those using kind of like the landline phones for all these corporate America. So, which they could kind of move you from the phone to the webinar to all over the place. So fundamentally, could the pain be over? That's what the trend roadmap's saying. But the pain might not be over. And again, you could always have these minor pullbacks, but that's probably the technically, meaning chart-wise in the trend roadmap, your most shiniest position in the Shane White index from the past.
Love it. Okay. So I don't know if that's good or bad. It just sounds bad because I think everything's pretty piss poor in that list, to be honest.
Things could change over time.
My portfolio, I'd be curious to know. So for people following you, roughly, so you said the S&P is down 20, the Nasdaq's down 30 this year. Where has most of, I don't know how you monitor that, but because everyone buys and sells at different points, but roughly where would you say you are this year, just to give everyone context versus the market?
Yeah, so if you just simply follow the signals on the S&P 500 as of this morning, you would be, so the market's down over 20. Following this buy and sell and hold signals, I think it's down 7.
Okay.
If you hedged, which I recommend on level 1, you'd be flat for the year. If you use the ETF strategy, which I call level 2, which is I share all 11 sectors of the S&P. I like to share a few other ones like Bitcoin's on there. That's been at a very big sell. There's a whole bunch of other ETFs that are on there. That is up single digits for the year.
Okay.
Nice. And then the billion-dollar fund manager stocks are somewhere down like that 7 to 10-ish% compared to if you buy and hold, that would be down like 30 of those individual names. Not nearly like the exponential growth, like the ARK funds, which are down like 60-ish. So again, by just cherry picking individual stocks, there's more risk. There's more exponential upside when the market's golden. But hedging in all 3 of those examples would have kept you either flat for the year or in kind of negative single digits versus negative double digits.
That makes me feel even worse, Scott, because I'm looking at so this isn't like everything, but this is pretty much my correlation to the list you're looking at. I use Robinhood for a lot of like, I would call it like my fund trading, right? I'm down 37% this year in the last 12 months. So I am getting smacked.
I am insanely transparent. I have a tab called Scorecard where I just track everything.
Okay.
But I'm sorry. But you're always welcome to invest with some rules. So, but I do have
I'm sold.
Mousetrap. Again, nothing's perfect in this world. There's always risk, but you will get kind of a signal to say, hey, something doesn't look right, and you don't have to kind of wait for your quarterly meeting with your advisor to have a kind of a conversation you didn't want to have in the first place.
Right. No, I love that. And for everyone listening, I mean, I'm sure a lot of people that listen to this are in the similar boat, whether you work with someone or you don't. I've kind of been in this boat for a long time. And it's probably honestly a little bit of arrogance of just having a finance degree and then working in finance. I'm like, oh, I know what I'm doing. Like, I don't need to pay someone to do this. I've been learning over the last 2 years, especially with COVID. It's like, especially if you're doing something professionally and you don't have the time. I've realized over the last year and a half of starting my own business and the podcast is I just don't have as much time as I used to spend when I had a corporate job looking at the markets, which is probably, a good thing. That means I'm working hard on stuff. But so all of that to be said, I think what you're doing is awesome, Scott. And I appreciate you explaining it. And it's really cool because I think at the end of the day, having rules, I know that's the name of it, so I'm not trying to do a pun here, but having rules that's data driven, right? Like that's so important for people, especially when it comes to your money and investing. If you make decisions based off of data, I'm just a big advocate for that versus being emotional with it.
Yeah, I completely agree. I think just like having that background in finance, to have that financial planning buttoned up is so important. But then also, I mean, I just think it's so easy just to buy and hold and kind of not look. But individual stocks, I mean, we are getting into a tighter credit environment. If they can't raise the money they need, it could get ugly. At some point, maybe the Fed turns around and the whole thing changes, and I am full of buy signals. It could easily happen, but at the moment, most of everything that's data driven says be careful.
Yeah.
And I wish it didn't, but it does. And I hope over time that that there's less pain to be had, because I never feel good. I mean, whether performance is like up for the year, flat, or even down a little bit, you always want to do better, and you always want to do, and you always want to protect. I just adore my members, so I always want to protect and help them as much as I humanly can.
Got it. Love it. And we got a minute 30 left before I get kicked off of Zoom. So is the one last thing I wanted to ask for people listening, I'll put the links to get to all of your information just for everyone who's listening, who is interested. What does becoming a member look like?
Yeah, absolutely. So becoming a member looks like you will get a monthly report that tells you exactly what these billion-dollar fund managers are buying and selling. You do get access to a live spreadsheet that covers really about your incremental, how much time you can deploy, whether it's stocks or ETFs, and are they in buy, sell, or holds. It's very intuitive. There's videos that explain it very clearly, short, nice, easy ones. And then every single week, I kind of cover what's going on, the trends in the market, what's going on with the major asset classes, what to think, what's maybe going against the grain. And then from there, I answer lots of Q&A from members that are kind of what's going on in their minds. And I hope it provides them an enormous amount of value, kind of getting a second opinion on what's going on in the world.
Love it, Scott. Well, thank you so much. I appreciate the time today. This was a very fruitful conversation. It's got my mind spinning on all these things I need to go and change after I get off this call. So I appreciate it, man. Thanks for coming on the show.
Yeah, absolute pleasure. Good to talk to you again.
All right. Good to talk to you, Scott. Have a good one.
You too.